Today, my guest is Logan Hertz with Hazelton LLC. Also, where I have found Logan was on YouTube, and the YouTube channel is Hazelton LLC. Is it Hazeltine?
It's technically pronounced Hazeltine, but I never correct
Hazeltine.
anyone, so
All
it's
right,
a
let me
German
redo it.
name.
Hazelton,
Hazeltine.
Hazeltine. Okay, Hazeltine. Today, my guest is Logan Hertz with Hazeltine LLC. Also, I've found him on YouTube. His YouTube channel is Hazeltine LLC. Welcome, Logan.
Thanks for having me, Glenn. Great to be here.
Yeah, it's great to have you on, and we've met a few times and introduced us to some lenders and gone over the infinite banking process. But for the show, could you just tell us a little bit about your backstory?
Yeah, it's a pretty boring backstory. I don't have a very dramatic one. When I first started making money, I was just looking for answers, and I went to your standard financial advisors, just asking questions and trying to get an answer as to what should I do with my money, generally speaking. And I just wasn't very satisfied with the answers. It really all boiled down to buy mutual funds and put your money in retirement accounts. And neither of those ever made any sense to me. No one had a good answer as to why I should do such a thing. And there's no guarantee of anything when you do that. You're just gambling. And when you put your money in a retirement account, you're giving up liquidity. You're locking your money up in jail where you can't touch it for a long period of time. So why would you do that? I don't understand. And so then I started looking for alternatives, and it was in the process of exploring one of those forums where I remember someone was asked a question. If you could tell people one thing about finance, what would it be? Now, this particular forum was about buying gold and silver, which I was looking at as an alternative. And so I was expecting the answer to be something related to precious metals, of course. But actually, that's not what the person said. What that person said was if I could tell people one thing about their finances, it would be replace your bank account with dividend paying whole life insurance. At the time, I had no idea what whole life insurance was. I've been on
Wah,
this
wah,
earth for
wah.
I had been on this earth
That-
for multiple decades. I had no idea what whole life insurance was. The idea, wait, life insurance that pays you? I thought I pay the insurance company. That's the way it works. So thankfully, I had no prejudice against it, which many people do. And I was viewing it as a bank account right from the get go. So I was viewing it very differently. I was not viewing it as life insurance per se. And that started a multi-year process of trying to get to the bottom of what is this thing? How does it work? Because at that time, information was not as available. But even so, most people, I think, don't do a very good job of explaining it. And it's not the easiest thing to understand or explain. But eventually I got to the point where I felt I was comfortable. I understood it and I wanted to start doing it. And then eventually COVID gave me the push out the door to do something I had been toying with, which was to turn it into a business. I actually started doing infinite banking as a business. And so now infinite banking is the main thing that I do. I also do velocity banking and some other things, but mostly, primarily, what I do is I help people understand the infinite banking concept. I design policies for them and then help them implement the infinite banking concept in their lives.
yeah. So, from my experience, I have a few scenarios where really the common personal finance direction is invest in your 401k, try to put in as much as you can, invest your future self will thank you. And for me, I have a few
Wall
scenarios
Street will
where,
thank you.
yeah, exactly. And what I have found is for me, I was maxing out my 401k probably for 3 to 5 years. And I had a few friends that were buying real estate at the same time. And for what I had saw, there's a couple guys that I know that are in business, but real estate just seems like the most understandable just because it's just very checks and balances. It's very direct. There's not too complex. You're buying a box and knowing what the revenue is going to be or what the potential revenue is to cover any debt or anything like that. So, anyways, I'd have friends that were doing real estate. I always loved real estate and I wanted to invest in real estate, but all I would do is lock my money up into a 401k. So that experience, and it was so hard for me to stop because of everyone that was telling you. It's like the story of listening to the 99% to expect to be the 1%, which is the opposite of what happens. You have to do something different. And so, anyways, whenever I decided to stop putting money into my 401k is when my financial picture changed. And I have a few personal experiences with family members having to pull on their 401k and having serious consequences at the worst time. You pull on it and exactly what you need to do. You need to cash out your 401k to make sure you don't lose your house or whatever medical emergency happens. And then while you don't have any money, you have your money in the 401k or you're getting taxed at the highest rate you'll ever pay because you're in emergency mode. Say
Mhm.
your income is 50,000 or 100,000, you pull 50,000 out. Now you're at the top tier of this income that you aren't even normally paying this because you would have paid it at a lower rate if you would have just taken the income and put it into a different savings vehicle.
Mhm.
And that penalty plus the 10%. And that is something that I don't see it as a winning game. And it's a lot riskier than people would say. You would say, oh, you're very risk adverse if you're putting your money into a 401k. And that's how this whole idea started to change in my mind. And I had friends that were buying real estate, able to refinance and get themselves out of the rat race. They were able to control their time. So that's how I got into looking into other options. And that's now we're talking to Logan Hertz. And so tell us, we've heard about the IBC on the podcast, but if you could
Mhm.
just for anybody that's the first time, I'm sure there's a few new listeners, just tell us a little bit about what
Yeah,
infinite
yeah.
banking is.
So the infinite banking concept is the process of becoming your own banker. So instead of using a standard conventional bank account where you store and use your money, so you store your money in a Wells Fargo bank account and you use it by withdrawing money whenever you need it. Instead, you're going to store your safe, liquid, accessible capital inside of a cash value life insurance policy where your cash is growing at a tax free guaranteed rate plus dividends, competitive with a savings account. There's also other protections in there as well. There's creditor protection. There's, of course, that permanent death benefit, which is really important. But most importantly, when you go to use the capital that's in your cash value life insurance policy, you do not withdraw it. You could do that. It's called a surrender. But what we do instead is we borrow against that capital strategically using what's called a policy loan. Now, a policy loan is not a debt. So when you take out a policy loan, you are collateralizing the cash value of your policy and taking out a loan against it. But on that loan, there are no repayment terms whatsoever. So this is what we mean when we say you become your own banker. You now decide what the repayment terms are going to be, and you're going to pay that loan back according to the terms that are most advantageous to you. And that depends on your situation. Meanwhile, the full principal balance in your cash value policy keeps earning because you never withdrew anything. You just borrowed against it strategically. Similar to when you borrow against real estate, you don't lose any of the benefits of that real estate. It doesn't go down in value. The rents don't go down. Everything's still there. And you pay no taxes. Everything here happens tax free because the cash value growth is inside of a life insurance policy. It's not an investment, it's not a savings account. And then we're never realizing a gain. We're just borrowing against it. So why does a policy loan have no repayment terms? Why are the insurance companies so generous? And by the way, the policy loan in most states is actually a legally required, contractually guaranteed right that you have. So if there's no credit check, there's nothing like that. They can't decline you as long as you have the cash value available, as long as you have the equity available in your policy. And the reason why there's no repayment terms is number one, there's a death benefit on that policy, right? And the death benefit by construction is always more than the cash value. So if you never pay a policy loan back, all that happens is the death benefit pays off that loan, right? Also, the cash value growth is guaranteed, right? So the insurance company who's making you that loan is not worried about the collateral. The collateral is guaranteed. It's the safest collateral there is. Mathematically, you cannot default on that loan. So it's a very unique credit instrument. And so instead of running our money through a bank account where when we spend it, that money's gone and it's not earning for us anymore, we run our money through our policies where when we spend the money, it's still in our policies and it's still earning for us.
Yeah. So just to add more to it, and what I'll say is one thing I always struggled with when I was researching infinite banking is that there was always somebody selling a policy at the end of it. So I always thought, this
Mhm.
person is selling me this because they're going to make commission. That's the immediate thought. It's what's this person's catch? And I will just tell you that, just to disclose, I do not sell insurance and I don't intend on selling any insurance. I buy real estate. I love real estate. And
Those
I,
evil little realtors make commissions though, don't they? How dare them? They're just trying to sell you.
well, I, yeah. So I would say that I generally love talking about infinite banking, and probably research way more than I need to. But
No
I
such
do,
thing. There's no such thing.
I would say I learn something new once a week, I would say. So what I would say, just my own perspective on the infinite banking concept. And the main thing is that everybody compares it to an investment, and I would not call this an investment. This is
Correct.
a place where you store your cash,
Correct.
and you're getting two things out of this: a place where you can store your cash, and you're getting life insurance. So, life insurance being very important. You're bridging your wealth to where you plan on being in the future, and it's a guarantee. You're
Yep.
It's
That's a
something.
great phrase, by the way. I like that. Bridging your wealth. Because what you're pointing out is when you take out a whole life insurance policy with $1 million death benefit, you're now guaranteed to be worth $1 million. Either while you're alive, you pay those premiums, eventually you'll build up $1 million worth of cash value,
Yep.
or when you die. So it's a self completing plan with a guaranteed result. And I know it's not an investment, but if you put it in a 401k, there's no guarantee that your plan is going to work out. Here we have a guaranteed result. You've already reserved your spot in line for your future legacy. It's just a matter of when. If you live long enough, it'll happen while you're alive because you'll keep paying those premiums and the cash value will keep compounding even while you're using it. Or God forbid you get run over by a truck tomorrow. Now the insurance company completes your plan for you.
So, also, where I was going to go with that to compare it is a 401k is not a stock investment. It's a place where you put your money. You can invest your 401k in many places. Most people are forced to put it into stocks or a money market account or whatever the case be. But that is what a 401k is. So a 401k, you can defer your taxes. It's not that you're eliminating your taxes. You actually are, in my opinion, creating a tax bomb when you're 70 years old. If you're a good saver, like a lot of people I'm sure that are listening to this podcast are diligently saving, putting their money in. And then once this thing gets to a large enough amount, we're at the mercy of what the government has, tax rules that they've created within the past 30 years. If you started this when you're 20 to 30 years old, 30 years into this, you're predicting what the government's going to do, which who I couldn't even predict what's going to be happening in 5 years from now. So the reason why the 401k just didn't stick with me is just that we're almost, when you're at an employer, you're pretty much forced to stick it into you're trying to, your plan is you're making more now to make less later, which isn't a good business plan for anybody. My goal is to ideally make more in the future. So if I'm making less now, I would rather pay the taxes now to know that I'm going to have a lot more income in the future that would have to be able to shield taxes. But the opposite of a 401k is pay a ton of taxes when you're 65 to 70 years old if you were successful. And if you're unsuccessful, you'll pay less taxes, is what the sales pitch is. And I don't know if I'm sold on that idea. And so, anyways, back to the, so what I'm saying, back to, it's not that I'm saying to invest in stocks or not invest in stocks. It's more of the asset you hold your cash in, which would be a 401k that gives you one thing, and it's a place to put it's, you have a lot of rules that where you can put your money. And on top of that, you have a tax bomb at the end of it. With life insurance, you are buying into a whole life policy, and the first 2 to 3 years is when you start building up the values, and within year, we'll say between year 5 and 7, you're all the premium, if the policy is constructed correctly, from what I've seen, the amount of premium that you put in will be about break even at year 5 to 7. So you haven't lost any money. It's just building the cash value inside the policy. And what at the same time, it's guaranteeing that if something happens to you, and here's another idea that somebody told me about life insurance is if, say, something were to happen to me and I have 2 kids and I have a wife, and we'll say we're living a good lifestyle. And if something were to happen to me, how would my wife survive without that? And she probably wouldn't be able to, she would have to find somebody else, is really what it would come down to. And she'd be pressured to find somebody else. And my thought was, do I want that person? Do I want my wife to be pressured to bring another man into the house and with my kids if it's not the right person? And I thought that doesn't sit right with me. So that's whenever I started thinking I definitely need life insurance. And go ahead.
Yeah, yeah, your human life value. So first of all, most people, they fully insure their houses. They
Yeah.
fully insure their cars. They would never think of not doing such a thing, but they don't fully insure their lives. In fact, they don't even know what their human life value is. So when people ask, how much life insurance do I need? That's the wrong question. Who's the expert at determining your human life value? It's not you. It's the actuaries at the life insurance companies. They're the ones who are the experts. So they'll tell you what your human life value is, and it's a multiple of your income typically. So depending on your age, it might be 30 times your income. So if you make $100,000, they will give you $3 million of death benefit, and you should absolutely not accept anything less. Take out $3 million of convertible term life insurance. So term life insurance, now we're not talking infinite banking, just talking life insurance. Term life insurance, of course, is inexpensive. So affordability shouldn't be an issue. If it is, I would question your priorities, but you have the guaranteed right to convert it to whole life at some point in the future. What that means is you've protected your insurability. Because Glenn, no one believes me when I tell them this. Nobody believes me, but it is possible that something negative could happen to your health. It's possible. And you might still be alive, but maybe you can't get life insurance anymore. Or maybe now it's much more expensive because you had a cancer diagnosis. It is possible. Now, unfortunately, most people I talk to have been gifted with invulnerability, so they don't need life insurance. They don't need any kind of insurance, really. But sadly, some of us have not been gifted with invulnerability. So again, protect your insurability, lock in your full human life value. So don't think of it as much from the perspective of, well, what would my family need if I'm gone? It's more, what am I worth to my family? And I'm going to protect that. So I'm locking in that future net worth of $3 million today with a convertible term policy. So if you ask, what do I need? Well, the answer is zero. Nobody needs life insurance. Nobody needs any form of insurance. The question is, what do I want? And do I want to condemn my family to subsistence living if I die? Or do I want them to continue to live at the highest standard I can possibly provide? That's nothing about whole life insurance or infinite banking. That's just properly understanding the place that insurance plays in your financial future. And I think most people understand that when it comes to homeowners insurance and car insurance. But for some reason, when it comes to life insurance, there's this big disconnect.
And I would say also something I wish I would have done when I started researching IBC, because it was like a 3 to 5 year process of hearing about it, not doing anything. But I did get terms. And the one thing I would say is if you do have term, or if I would have gone back to do it over again, I wish I would have just signed up for a convertible term policy. And generally, I would talk to that person that's talking about
Infinite banking.
IBC
Yeah, I would say, so
practitioner.
come talk to someone like me who's an
Yes,
infinite banking person and
yes,
say, look, I'm not ready yet, but can I just take out a convertible term policy? Because then you'll have two very important things. The term policy will be convertible with a company that has a really good whole life product,
yes,
because not all convertible term policies are created equal. If it's a convertible term policy with a company that has no whole life product, or they don't have a very good one, then that conversion privilege isn't worth a whole lot.
yes.
And you want to do it with an agent who knows how to structure policies properly. And then if you never do infinite banking, you never do whole life, still, at least you protected yourself. So if something happens to your health, you still have options. And then if you do decide to do infinite banking, you won't have to worry about health getting in the way. Because unfortunately, that does happen. Because to your point, it can take people a while to learn about and get comfortable with the idea of infinite banking. Great. Don't rush that process. Learn about it. While you're doing that, reserve your spot in line.
Yep.
And whether you do infinite banking or not, that convertible term policy makes perfect sense.
And also on top of that, depending on how long the term policy is, you can buy yourself as much time as you want. But what I have seen just this past year, I've seen a couple people, well, I haven't seen them die, but they did die and they had nothing left behind. And it's something that I literally, it triggered me to say, I think that was the deciding factor to just get some whole life insurance. And also, what I'll say is, after doing a lot of research, and I'm telling you this as not selling a product to nobody or about whole life, is I believe 100% is the best place to put your money. And that's not investment advice, but
Yeah,
at the
it's not an
same time,
investment, thankfully. Yeah. But
that,
this is coming from someone who's not a life insurance agent. Because
yeah,
I think you're right. Unfortunately, what I've noticed is that when I sift through the objections to infinite banking and whole life insurance, and the people who object always blur those two because they are two different things. So they confuse them. But we can talk about them together here. When you sort through it, really, there's no actual substantive argument. There's just a bunch of misconceptions about infinite banking. There's a bunch of misconceptions about whole life insurance. And once you sort through all those misconceptions, say, where's the actual substantive argument here? It boils down to what you said earlier, that really what they object to is that you're going to make a commission when you sell that policy to them. I don't understand why people have this scarcity mindset, this Marxism. I don't know what it is, but why do you hate someone else for making money? When I go to my local farmer's market and I buy this good free range chicken from the farmer, he makes money off of me. I could call that a commission if I want to. Glenn, it's funny. Call me naive, but somehow I don't feel like I've been exploited after I buy that chicken from the farmer and I go home and enjoy it. Somehow I don't feel like I've been exploited. To bring it closer to home, when I talk to my property and casualty insurance agent and he sets me up with my homeowner's insurance, my car insurance, my liability policy, I know he's making a commission off of that. But somehow I don't feel like I've been taken advantage of when we put those policies in force. In fact, this makes me a total sucker, I know. I feel like he's done me a service and I hope he makes as much money as possible. Why would I not want him to make money? I don't understand this parasite mentality that seems to be behind this. Because when you really dig into the psychology of a lot of these objections, it gets pretty dark pretty quickly. Because really, what people are saying is, I hate success. I hate other people making money. I want to tear them down. I feel like wealth is a zero sum game. Thankfully, wealth is not a zero sum game. If you make a lot of money by way of commission, that's an indication you added a lot of value to a lot of people.
yeah. So now we'll just say that we're convinced that whole life insurance, infinite banking is the way. And now we are starting to put money into the policy. And we'll just say within year 2 or 3 is when it starts to get legs and the premium no longer becomes an issue, is what I would say. It's like what I've been told, and this would be a total sales pitch, but back to I understand what they're saying because it's really how you structure the policy is that the first year should make you sweat. And I feel like I did that to myself because it's in the back of my mind. I'm like, man, I need to really put some money into this thing. And so, anyways, say the policy that I'm doing is it's 60,000 a year of premium, which is a lot of money. And the way that it's 39,000 of cash. It'll be between 36 and 39,000 of cash value. And but what I would say is that 39,000 you paid, we'll say 20 to $25,000 towards a whole life policy. And then in the second year, you'll probably pay 5,000 towards the whole life policy because you'll have 55,000 out of the 60,000. And then the third year, you'll pretty much be at close to 60,000 will be 60,000. So no longer are you paying for whole life insurance. You're putting money into your bank. And so from there, you have access to that money pretty much in year one, but it started to accumulate. And the more you put into the premium, the more your policy grows. And that policy goes from dollar to for every dollar, it's a dollar 10 cents. Then for every dollar, it could be a dollar 50. So it starts to really over time start to season. And say these policies, well, by year 65, it'll be about $300,000. And as that money comes in, I can pull it out and I can put it into real estate. And then all the cash flow flows back into the policy. And then over time, that policy will actually, it's like you can't rob your own bank. You have to constantly pay the interest. So you always have to repay yourself. And if you're not repaying yourself, that's like stealing your own inventory, which they call stealing the peas, but it's stealing your own inventory from yourself for future self. But over time, that income will constantly grow as you're churning the money. And then eventually, your current policy becomes too small that you'll actually need to add on more to it. And that's the purpose of having a term rider that kind of keeps the whole policy alive. So if you try to get the largest death benefit and then you have the whole life that's inside the term rider, that would be like maybe 1/5 of the policy, but you have still a runway for this other term policy to grow. And over time, you'll have more of a velocity of income that comes in and out, and it's always being reinvested. And by the time you're deciding to retire or slow down, you'll have a full income source from all these investments. And you've also bridged the gap of wealth. So you started with the end goal. Like my end goal in this life insurance policy would say $7 million. So as I'm putting money into this policy, I have money going in and out. And at the same time, the income is constantly going up. At the end of your retirement, if you have your money in stocks or some kind of other asset, the end goal is income. But if you've been building your income the whole time, that means that you actually have a better measurement of when you can slow down, maybe take a entrepreneur adventure from your W-2. And that was the main thing for me is I was able to personally get my income up to $5,000 a month from investment real estate. And it gave me the freedom to step away from a very $150,000 year job to make $1,500 a month. And it was because I had the investment real estate to pay for me to leave. And it made me comfortable. I had 2 kids and there's a lot of things. And that's the encouragement that the infinite banking policy puts in place compared to a 401k where you're just trying to sock away as much money into it with really forcing yourself to be illiquid until your 60s.
Yeah, yeah, and I like the way you said it because you are recycling money through your system. So money comes from your policy into your real estate and then gets recycled back into your infinite banking system. So what's happening is you own the property and you own the mortgage. So you own the property and you own the financing mechanism. So the cash flows that would be going out to a third party lender are now coming back into your system recaptured. So the way I explain it is when you pay premiums into your whole life policy, you are permanently capturing those dollars inside your personal economy where they can never escape and where they keep earning for you in a safe, guaranteed, tax-free manner from now until the day you die. So everything starts and ends with your whole life policy. It's not your investment, but it's the source of liquidity that funds the investments. And then it's where you put those profits from your investments once they start cash flowing. And then meanwhile, it keeps growing. And then you can use that to fund the next set of investments. And then you take those profits, put them back into your bank and so on, so that it's ever expanding. And as far as income goes, your whole life policy itself can also be an important source of retirement income once it really gets seasoned.
Yes.
So what drives the whole life policy is actuarial math, but to say it in layman's terms, really is compound interest. Compound interest is amazing, but it needs time. It takes time for it to get going, which is why the early years of a whole life policy are boring. That's the downside. That's the drawback to whole life. That's the drawback to infinite banking is it's not a quick turnaround. It's a slow process. But once it gets going, it gets exciting in those later years to the point where the compound interest train is going so fast that you can now safely take out policy loans in retirement with no intention of repaying them because the compound interest you're earning in the policy is more than exceeding the income you're taking. And so you have another source of retirement income. And it also gives you more safety too, because it's a guaranteed asset. So if some of your investments are not doing well, you can pause the income from those investments, wait for them to recover and make up the gap by pulling from your whole life policy because that's guaranteed. It's never going to go down. And of course, it's all tax free and protected by that permanent death benefit, which also in retirement is very important because it can be used for long term care. So I'm sure we've all heard stories of people dealing with end of life issues. And those can get very expensive. Thankfully, if you have whole life policies, that death benefit can be used in advance of your death. If you have a terminal illness or a critical or a chronic illness, then you have access to those funds. That covers a huge gap that most people have in their retirement plans. Because as Tom Hegna says, if you don't have a long-term care plan, you don't have a retirement plan.
It's very expensive. I've done a lot of research on that as well. I've actually had a license to sell it, and I sold one policy. That I actually have had a health life variable annuity license in the past,
Okay.
and the only
Okay.
policy I sold, which is probably the hardest one to sell, is long-term care. I sold one policy, and I got into real estate pretty quickly after that. It was one of those things, but it's 8,000. Even today, it's between $6,000 and $8,000 a month for long-term care, and that
Yep.
can lose a nest egg pretty quickly at that rate. So there's a couple things we've already talked about. My favorite topic is compound interest. My new favorite topic is IBC, and my previous journey before I found the IBC is velocity banking, which I see you as one of the experts in this field. I've seen a lot of your YouTube channels. And if you could, let's talk about how we have velocity banking and
Yep.
life insurance together.
Yeah, I view velocity banking and infinite banking as being very complementary strategies. So, what is velocity banking? It's analogous, except instead of using a whole life policy, we're using an open ended line of credit, typically a home equity line of credit. So, what you can do as an example is you can replace your mortgage with a first lien HELOC, first lien home equity line of credit. And then you'll have a bank account that's automatically linked to your HELOC. So income comes in, it gets applied to your HELOC balance immediately. When you pull funds from your checking account, it gets pulled from your HELOC. So what you're doing is you're banking out of your home equity. So your cash flow is flowing through your home equity. So every time funds hit your checking account, it's paying down debt. What for most people is their largest debt. By the way, this can be done with investment properties too. You can do first lien HELOCs on investment properties. You can do the exact same strategy where you're taking the rental income, popping it into the HELOC. And so what happens is all of your money is now working for you. This is why we call it velocity banking. You're giving your money velocity. It's paying down debt. It's growing, participating in the equity buildup in your house, the capital appreciation in your house. And so it's working for you in that way. And then, of course, a HELOC charges simple interest, whereas many other debt instruments charge compound or amortized interest. Whereas here we have a simple interest environment, which is the most effective, efficient way to pay down debt. So the typical use case for velocity banking is paying down debt because you can now refinance a lot of these debts into your HELOC. But it can be used for other things like investing in real estate. You can pull from your home equity and go make a down payment on a rental property. So it's like a BRRRR strategy, but without the need to refinance because you've just got this line of credit and it's a two-way street. That's the most important thing. It's a two-way street. It's not a one-way street. When you take out a mortgage, it's a one-way street. You pay money into the mortgage, but then you can't pull it back out. Here, it's a two-way street. You can pay it down and pull it back out, pay it down, pull it back out as much as you want. Combining velocity banking with infinite banking is where I start to get excited because these two are very complementary. What you're doing is you're building two strategic pools of liquidity. One in your home equity, that could be your primary home, that could be your portfolio of real estate investments. And you have ready access to it through this HELOC strategy. So you have one pool of liquidity in home equity, and then you have another strategic pool of liquidity in whole life insurance, the cash value. And they both have advantages and disadvantages, but that's very complementary. So as an example, one of the things you mentioned, Glenn, that we both mentioned is that when you pay premiums in your whole life policy in the first couple of years, you're taking a loss in liquidity. If you put $100,000 in year one, you're not going to have $100,000 in cash value available to you. The insurance company has to make money too. You're paying for a death benefit. There are other things you're paying for than just cash value. It has to be profitable for you and the insurance company. One of the ways you can address that is if you take out a first lien HELOC on your primary residence and you have some equity in your house, You just made up that loss of liquidity in spades. Maybe you have $200,000 of equity in your house. If you take out the whole life policy and you take out the first lien HELOC, yes, you lost, let's say, $20,000 of liquidity in your whole life policy in year one, but you gained $200,000 of equity in your primary residence. So on net, you're actually ahead $180,000 worth of liquidity. And now that you have these two complementary systems, you can use them to feed each other in the way that makes sense for you. You could take out a policy loan from your whole life policy and pay down your HELOC. And if you're just myopically focused on keeping your interest costs as low as possible, that would probably be the right thing to do because the policy loan interest rate is going to be lower typically than what's charged on a HELOC. You could also do the opposite. You can pull from your HELOC and pay premiums into your whole life policy. What you're doing there is you're saying, I'm going to pay more interest now in the short run and take on a larger cost now in the short run. But the compound interest I'm going to earn in my whole life policy over the next few decades is going to way outstrip any of these early interest costs. And in one of my videos on what we call infinite velocity, I have to give credit to Sebastian Boyer. That's what he calls it when we combine infinite banking and velocity banking. I talk about infinite velocity and I go through a use case and I show how those early interest costs may very well be worth it because what happens is if I decide to do infinite banking and I'm also doing velocity banking, I'm going to slow down my debt payoff. So let's say I'm doing velocity banking to pay off debt. If I then add in infinite banking, I'm going to slow down that debt payoff because now I have cash flows that have to be redirected to the whole life policy that cannot be used to pay off debt. So I'm going to pay more in interest costs. Okay. But I'm going to earn a lot more over the long run. And the problem is we see the interest payments that we have and we feel pain and we want to reduce them. We don't see the massive opportunity cost of waiting 2, 3, 4 years to start a whole life policy. And what I show in my videos in the example I give, if you wait 3 years to start your whole life policy, you lose more than $500,000 of retirement income because you waited 3 years to start your policy. And that's just with a $25,000 annual premium. So we show how what happens is by starting the whole life policy sooner, you end up paying more in interest. I think it was about $50,000 more in interest you pay over 9 years because you're slowing down your debt payoff. So Glenn, is it worth it to pay an additional $50,000 in interest costs over 9 years in order to gain more than $500,000 in guaranteed tax-free retirement income?
Yes.
I would say yes. The problem is people see the interest that they're paying. They don't see the opportunity cost. And that's what we have to show them. That's what we have to make the unseen seen. So that's the power of combining velocity banking with infinite banking. It allows both of your systems to grow faster and larger and better and safer because you now have more liquidity and you have the guarantees associated with whole life and you have more flexibility. You have two different financing mechanisms and you can toggle between the two according to what makes the most sense for you. Do you want the control and the lower interest rates of the whole life policy and the guarantees, or do you want the flexibility and the higher upside of home equity? And the answer, of course, is both.
Yeah. So I'll tell you my velocity banking experience. And what I did is I had we'll say $170,000 mortgage. And then I looked at I learned something called recasting a mortgage where you can pay down a mortgage like a lump sum. So the reason why people do this is they say they have a house, they move out of that house and move into a new house, but then they have to sell the first house. So they sell the first house and then they take the proceeds from that house and pay down their new house. And they don't have to get a new mortgage because they have cash now that they just sold their house. So they recast it and they get it down to whatever number. But what I didn't have a house to sell, but what I did is I took a line of credit and I started paying down my house. And my goal was to get it to $95,000 because when I do that, my monthly payment would be $500 a month. And that's what I did with as velocity banking. So I would take a line of credit out against my house and pay down the house. And then my monthly payment was $500 once I did that. So what I'll tell you as you were talking about it, that the better way to do that, if you were to do that, is instead of taking money and paying down the principal, Because this is the thing, I don't actually understand as I'm doing it. If I'm putting $10,000 or say $5,000 a month towards my house or a couple thousand, whatever it is, it's a slow process. And I don't actually see what the real cost of paying down my house to figure that out is. But if I were to say, here's $70,000, you're going to pay down your house with this and you're going to save yourself like 300 bucks a month is really what it would turn, 3 to $400 a month. Can you find a better investment that you can put $70,000 in and get better than 3 to $400 of cash flow? So the answer is yes, for me at least. And so what I should have done, or hindsight, knowing what I know now, is I could have opened up I had a term life insurance policy, but didn't understand whole life at that point. But if I would have had that knowledge of the IBC, I could have funded the whole life policy, get the cash value to whatever number that could be 70,000, or we'll say it's a little bit more than that because you have to have some left over when you pull. But we'll just say get to $80,000. And then you can make an informed decision because you're still earning interest on all those funds and you're paying down. So it's almost like a wash. That 70 grand would have been a better decision. I would have been able to measure this decision a lot better if I, instead of just saying I'm going to put 5 to 10 grand a month into my mortgage, that really I didn't save that month. I think my mortgage was 3% at the time. I
Mhm,
wasn't really looking into that. I was
mhm,
gung ho about paying off my house or
mhm.
something like that. But I would say that that whole time I'm becoming illiquid. I'm paying down my
Yep.
house. Money's going away. If something happened to me, it's stuck in my house. I'd be a forced sale or have to go back to the bank to beg for money.
Mm.
And that's really what I'm trying to get away from. So I could take it and put it into this whole life policy that whenever I need the funds, say if an emergency did come up, I could ask for $10,000 and bring it right back out and use it towards that emergency. And that's what I should have done. And I obviously today that policy would have been a lot larger than what it is today. And those are just small things. And that's the main purpose of this podcast right now is to open eyes to see exactly it's not an investment. It's just a holding place for your money while you make your next informed decision to invest into whether it's cash flow or an emergency that you need, job loss, or you decide that you want to start your own business and you might need a long runway or cash reserves before you
Yeah.
to feel comfortable with leaving your W 2.
Yeah. Liquidity, access, and control. Liquidity,
Yep.
access, and control. That's what you want. And you have it to a certain extent in both. I would say that in whole life, you have much more control because you have contractual guarantees. There's no credit check, there's no bank involved. You can access that money. Meanwhile, that money keeps earning for you. With a HELOC, you probably have more liquidity, there's more flexibility, but there is a bank involved. And we all know the banks are completely trustworthy and would never do anything except what's in your best interest. And HELOCs can be great, but that's one of the limitations. So, infinite banking purists would probably not do velocity banking. They would probably only do infinite banking. And that's totally fine because I view infinite banking as being foundational. Like that to me is required. Velocity banking, I think, can help quite a lot. It's an accelerator. I don't know that I would say it's required. Neither are required, obviously, but I would say infinite banking is foundational because that's where your capital is. That's your base of safe capital. Velocity banking is a very efficient cash flow management tool. And I'd say, especially if you're trying to pay off debt, velocity banking can be phenomenal. But again, I don't view the two as being in conflict. I would just say that infinite banking is more foundational than velocity banking. Also, with velocity banking, you are limited by how much home equity you have. There's a limit based on the value of the house, the value of the properties, the value of your real estate. Whereas with whole life, at least in theory, there's no limit. Now, that's where your human life value comes in, though, because the insurance company will put a limit on it. They will tell you, we're only giving you this much death benefit, and we will not give you any more than that. That's why I think it's so important that you secure your full human life value with convertible term. That way, no matter what happens, at least that much you have access to, no matter what happens to your health, and you have the option to convert it. If you don't secure it with convertible term, You never know what might happen. You might not be able to expand your system. You might want to expand your system and then you can't. You don't want to be in that position.
Also, another thing I was just thinking of is that sometimes having liquidity will get you a higher return than focusing on the daily. So if I could tell you from my own personal experience, say if my mortgage is $2,000 a month or whatever the number is, $3,000 a month. If I don't have a reserve, it's very stressful because I'm just making sure that the next check that comes in is going to cash, as in like a paycheck or whatever it is. But if I had 100 grand or 50, even 50 grand in the bank account, a 2 to 3 grand mortgage becomes a second thought. It's coming next month. It's going to happen. It's going to be all right. My boss just told me something I didn't like. I don't know if they're going to can me after this conversation that they have. Or my thing is that whenever I was at my W-2, they would have all the doors closed, and I'd always think that they're talking behind that door. They're talking about me. They're figuring out how to get rid of Glenn. And I would say having a healthy reserve and also increasing your cash flow, it gives you a more of a security over time. And I could tell you that I've done both where I didn't have any reserve or any cash flow, and it was very stressful. And then I've actually had cash flow and very low reserve, and that also makes it to where I'm making problems up in my head. But whenever I have both, where it's cash flow and reserves, my decision making becomes very calculated, not as
Yes.
emotional, and you'll be able
Right.
to make way better returns, in my opinion,
Mhm.
if that's the case. And
And as Rick Rule, a very successful speculator, would say, you can take advantage of crises and downturns rather than being taken advantage of by them because you'll have the capital when other people do not. So you're right. Your overall rate of return gets better. Look at Warren Buffett. Warren Buffett carries more cash in his portfolio than anybody else. I'm sure he's aware he could get a higher return on his cash if he went and deployed it somewhere, but he doesn't do that. He understands the importance of staying liquid. So you can pounce. There are times when you can get 1,000% rates of return when you have a 2008 crash, when you have a COVID crash, but you have to have the liquidity. So having that liquidity is key. And most people, unfortunately, put the cart before the horse, where they start investing before they start saving. And part of the way that they are manipulated is the financial powers that be tell them that they're saving for retirement by putting money in a 401k. That's not a savings vehicle. That's an investing vehicle, and you're giving up liquidity. Okay. That's not a saving vehicle. Putting money into whole life insurance is building liquidity. It's a savings vehicle. Putting money into a savings account is a savings vehicle. So you need to start with that foundation first. You start with the protection, the savings, then you can get into investing and then into speculating. And most of what goes by the name of saving or investing today is actually speculating. It's I'm going to put my money over here and just hope and pray it goes up in value. And that's it. That's really it. There's no other thought that goes into it. And many people contribute to their 401ks with no strategy, no thought process whatsoever. And in some cases, they take your money by default. You have to actually opt out of contributing to a 401k. What a great deal for Wall Street. They get your money by default. I would love to have that deal
yeah,
where I get your money by default. You have to actively opt out. So yeah, you need to save first. Offense wins games, defense wins championships. Again, Warren Buffett, number one investor of all time. Does he tell you higher the risk, higher the reward? No. He says rule one of investing, never lose money. Rule two, see rule one. And the
yeah,
irony is, the more you build that safe savings, the more you are able to aggressively speculate if you want to with safety, because you have that reserve, you have that liquidity, and you can now afford to be patient. You can wait for your investments to pan out. You're not going to have to draw from your investments because you have this safe, liquid store of capital. So when I started my business, I had savings. And as a result, I was able to take the long view because in my line of work, it's like whole life insurance. It takes multiple years to really build a business. It doesn't happen overnight. And you've got to have a way to pay the bills in the meantime. So you can maybe have a full-time job and do this as a side hustle. That can work. Or you could have savings, or ideally both. And that way you build your business the right way with a long-term view. and you're not having chase after a paycheck tomorrow.
That's awesome. Where can people find you, Logan?
Yeah, thanks. My number one thing really is my YouTube channel. So youtube.com/at Hazeltine LLC. I'm sure we'll include links. You can find me on LinkedIn, Logan Hertz, or Hazeltine LLC, my business page. I do have a website, hazeltinellc.com, but my primary educational platform really is my YouTube channel. I try to put good content up and educate people on infinite banking and velocity banking. And I would recommend everyone just keep learning about these strategies. And if you want to reach out to me, I'd love to hear from you. But if not, at least continue your educational process by talking to people like Glenn.
Awesome. Thanks for being on the show.
Thanks so much, Glenn. Great to be with you.
All right. Thank you.